Since January 2023, cash assets like US Treasuries have had bigger returns than the stock market on average. You can see that in this chart, which shows the spread between the S&P 500 earnings yield and the yield on a 3-month Treasury bill. Every time the line dips below zero, it means cash yields are higher than stock yields. This is only the 9th time yields have inverted for more than a few months since the 1950s, and it's an important signal for the stock market. If we add the S&P 500 on top of this, we can see that nearly every time the stock yields dip below cash yields, it corresponds with a major market top followed by a pronounced correction. So it appears to be a reliable signal of economic pain on the horizon. And since the signal triggered in 2023, the question is whether we're about to see that big correction or if things are different this time. Here's how the pattern has played out before. In July of 1980, the S&P 500 earnings yield was 7% higher than the yield on a 3-month Treasury bond, so stocks were very attractive. This helped drive a significant rally in the stock market. It rose 43% in just over a year. But then things flipped around. Inflation was out of control, reaching nearly 15%. This prompted the Fed to hike their effective rate way up to nearly 20% to cool down the overheating economy. Higher short-term rates meant higher yields on cash, and soon the yield spread inverted. By December of 1980, yields on a 3-month T-bill boasted a 6% yield premium over stocks. In just 6 months, the risk-reward ratio flipped, and cash assets like bonds became a much more attractive investment than stocks. The stock market entered a prolonged bear market, falling 27% from the end of 1980 until mid-1982. More or less the same story that played out in most of these other instances. Historically, once cash returns trumped stock returns, the market has usually contracted soon after. But notice how stock yields remained well above cash yields throughout this entire period between 2001 and 2022, with stock yields particularly high between 2010 and 2020. The big reason for that is interest rates. After the 2008 financial crisis, the Fed flattened rates to near zero in order to stimulate economic growth, and they kept them that low for almost a decade. So for that entire time, cash paid investors almost nothing. Meanwhile, the S&P 500's earnings yield was much higher. At the peak in 2012, stock yields were more than 7% higher than cash yields, which contributed to a remarkable stock market rally from 2009 to 2022. But that entire landscape has changed. Starting in 2022, the Federal Reserve launched an aggressive rate hiking cycle to fight runaway inflation after the pandemic. This pushed short-term rates from 0 to over 5% and dramatically increased the yield on cash. By July of 2024, 3-month T-bills had a 2% yield advantage over the S&P 500. But since 2020, we've only seen 3 sizable market downturns. The longest and most pronounced was the 2022 bear market, which started and ended before the yield spread had inverted, so it preceded the signal. The other two, in mid-2023 and early 2025, were both short-lived corrections which quickly turned around into rallies. We haven't seen the kind of deep, prolonged contraction that followed most of the historical scenarios in which cash yields were higher than stock yields. And whether or not that correction is just delayed or not gonna happen this time is of course impossible to say with certainty. But we can say this: in 1999, it took 2 years for the market to top out after cash yields outstripped stock yields, as the stock market was driven higher by tech hype in the internet bubble. There was even a short-lived correction on the way before stocks resumed their euphoric rally. So the signal was delayed, but once the market topped out and the bubble popped, so began the 2001 recession, bottoming out only after yields flipped back around. So far, this looks similar to what we're seeing today. It's been just under 2 years since cash yields outstripped stock yields, and despite a couple of brief corrections, the stock market has been rallying, fueled by the massive success of big tech and artificial intelligence companies. And as for whether or not that continues, there are 2 likely scenarios to consider. The first possible scenario is that the signal is delayed and a big correction is on the horizon, especially if inflation continues to rise and the Fed begins hiking rates to cool things down. That would grow cash yields even more, making stocks even less attractive. This could trigger a significant drawdown in the stock market, like what's happened before. Scenario B: if inflation remains stable or falls, the Fed could continue to cut rates, making cash less attractive and potentially flipping the yield spread back in favor of stocks. This would likely fuel a continued rally on the S&P 500 as investors flock to higher potential returns. At Capital.com, we'll keep you updated on the latest signals from crucial indicators like earnings yield and what they might mean for the stock market. Hit like and subscribe to stay tuned. Thanks for watching.